When people think about market crashes, they imagine fear, panic, and financial ruin. They picture traders jumping from buildings, families losing their homes, and retirement dreams turning to dust. But here's what they don't tell you in the history books or on the evening news. Every great crash in history has been followed by the greatest wealth transfer the world has ever seen. And those who understood the pattern didn't just survive. They became rich beyond their wildest dreams. The numbers don't lie. After the crash of 1929, those who bought during the depths of despair saw returns that would make today's tech billionaires jealous. When the dot-com bubble burst in 2000, patient investors who accumulated quality assets during the carnage watched their portfolios multiply by 10, 20, even 50 times over the following decades. And when the housing market imploded in 2008, creating what felt like the end of the financial world, it was actually the beginning of the greatest bull market in American history. Now, we're standing at the edge of another precipice. The warning signs are flashing red across every metric that matters. And if history is any guide, what's coming in 2026 won't just be another correction. It will be a complete reset of the financial system as we know it. The question isn't whether you'll survive the crash. The question is whether you'll position yourself to profit from it. Because here's the truth they don't want you to know. Crashes don't destroy wealth. They transfer it from the unprepared to the prepared, from the emotional to the rational, from those who panic to those who plan. And if you understand what's really happening beneath the surface, you can position yourself on the right side of the greatest wealth transfer in human history. Let's start with what everyone can see but few understand. The economic cycle in America has followed a predictable rhythm for over a century. Every 18 to 20 years, the system reaches a breaking point where debt, speculation, and artificial prosperity collide with mathematical reality. We saw it in 1929. We saw it in the stagflation crisis of the 1970s. We watched it unfold in 2000 and again in 2008, and now, as we approach 2026, every indicator suggests we're approaching the next inevitable reset. The Shiller PE ratio, which measures how expensive stocks are relative to their actual earnings, is sitting at its second highest level in recorded history. The only time it was higher was right before the dot-com crash that wiped out trillions in paper wealth. This isn't some obscure technical indicator. It's a fundamental measure of whether stocks are overvalued or undervalued based on their actual ability to generate profits. Right now, investors are paying prices for stocks that assume decades of uninterrupted growth at rates that have never been sustained in human history. They're betting that this time is different, that old rules don't apply, that somehow the laws of economics have been suspended. Consumer debt has reached levels that would have been unthinkable just a generation ago. Credit card balances exceed $1.2 trillion. Auto loans have stretched to 7- and 8-year terms just to make monthly payments affordable. Student loan debt has ballooned to over $1.7 trillion, with default rates climbing steadily. This isn't sustainable borrowing for productive purposes. This is desperation spending to maintain lifestyles that incomes can no longer support. Corporate balance sheets are loaded with cheap debt that will become crushing when interest rates normalize. Companies that should have failed years ago are being kept alive by access to credit at historically low rates. When those rates rise, or when revenues decline and refinancing becomes difficult, these zombie corporations will collapse, taking jobs, supplier relationships, and investor capital with them. And government spending has reached a point where even the Federal Reserve is starting to question whether the system can continue much longer. The national debt exceeds $34 trillion and grows by trillions more each year. Interest payments on that debt are consuming larger portions of the federal budget, crowding out spending on everything else. The mathematics are simple and brutal. This trajectory leads to crisis. But here's where it gets interesting. The same economists and financial experts who failed to predict every major crash in the past century are telling you not to worry. They're saying the economy is strong, unemployment is low, and there's no reason to panic. They said the exact same thing in 1999. When stock valuations reached absurd levels and anyone questioning the dot-com bubble was dismissed as a pessimist who didn't understand the new economy. They said it in 2007. When housing prices had disconnected completely from rental income and household incomes, and experts assured everyone that real estate never loses value nationwide, they were catastrophically wrong both times. They're wrong again now. Meanwhile, the smart money is quietly positioning for what's coming. Warren Buffett's Berkshire Hathaway is sitting on over $300 billion in cash, the highest amount in the company's history. Buffett did unbecome one of the richest people in the world by following the crowd or believing in permanent prosperity. He understands that market cycle, that what goes up must come down, and that the best opportunities come when everyone else is panicking. Major hedge funds are building defensive positions and accumulating precious metals. They're re-rotating out of speculative growth stocks and into companies with strong balance sheets and consistent cash flows. They're not doing this because they're pessimistic by nature. They're doing it because they understand history and mathematics. Institutional investors are quietly repositioning portfolios away from the sectors most vulnerable to economic downturn. They're reducing exposure to commercial real estate, over-leveraged corporations, and companies dependent on continued access to cheap credit. These moves are on making headlines because institutions prefer to adjust quietly rather than trigger the panic they see coming. The unemployment rate is expected to climb from its current level to nearly 5% by September 2026. That might not sound dramatic, but economists are placing the odds of a recession at almost 40%. And those same economists have never successfully predicted the timing or severity of any major downturn. The real probability based on historical patterns and current conditions is much higher. Manufacturing has already started to contract. The ISM Manufacturing Index, which tracks activity in the industrial sector, has been signaling weakness for months. Consumer confidence is beginning to crack as inflation erodes purchasing power and debt payments consume larger portions of household income. Credit card defaults are rising, doubling from their early 2022 lows. Commercial real estate is showing signs of serious stress. Office vacancy rates have climbed to levels not seen since the depths of previous recessions. Major cities are seeing property values decline as the shift to remote work reduces demand for office space. Banks that lent heavily against commercial properties are starting to recognize that those loans may not be repaid in full. These aren't abstract economic indicators. They're early warning signals of the financial earthquake that's building beneath the surface. The question isn't whether the earthquake will strike. The question is whether you'll be standing on solid ground when it does. But here's what separates the wealthy from everyone else. While most people see crises, the rich see opportunity. They understand that crashes are not random acts of economic destruction. They're systematic transfers of assets from weak hands to strong hands. From those who borrowed too much to those who saved, from those who chased speculation to those who accumulated real value. This isn't theory or wishful thinking. This is documented historical fact that repeats with such regularity that ignoring it requires willful blindness. Consider what happened during the 2008 financial crisis. While millions of Americans lost their homes, their jobs, and their life savings, a small group of investors made fortunes that would last for generations. They bought real estate at 30 cents on the dollar. They accumulated stocks of world-class companies at prices not seen in decades, purchased entire businesses for fractions of their intrinsic value. The homes that sold for $200,000 in 2009 were worth $400,000 by 2015 and $600,000 by 2020. The investors who bought them didn't get lucky. They understood that housing has intrinsic value based on shelter needs and population growth, and that panic creates temporary mispricing of permanent assets. Stocks of blue-chip companies traded at prices that made no sense relative to their long-term earnings power. Bank of America fell to $3 per share. Citigroup traded below $1. General Electric, one of the most established industrial companies in America, could be bought for less than $10. These weren't failing businesses. They were solid companies caught in a liquidity crisis that forced indiscriminate selling. The investors who recognized these opportunities and had the courage to act didn't just preserve their wealth. They multiplied it beyond anything they could have imagined. A $100,000 investment in the S&P 500 at the March 2009 bottom would have grown to over $600,000 by 2021, that SA six-fold return in just over a decade. But the returns were even more dramatic for those who bought individual companies at depression prices. Amazon stock fell from over $100 to just $6 during the dot-com crash. Anyone who bought at the bottom and held for 20 years saw their investment increase by over 400 times. Netflix traded for less than the cost of a monthly subscription. Apple, Google, and dozens of other companies that would later define the modern economy were available at garage sale prices. The same pattern played out in every major crash throughout history. During the Great Depression, John D. Rockefeller reportedly said that fortunes are made when blood is running in the streets. While breadlines formed and banks failed, those with capital and vision acquired assets that would generate wealth for generations. Oil companies, railroads, and manufacturing businesses changed hands at prices that would never be seen again. Real estate in major cities sold for fractions of replacement cost. Entire industries were consolidated by investors who understood that economic cycles eventually reverse, that assets purchased during panic generate extraordinary returns during recovery. The key insight is this: crashes don't happen randomly. They follow predictable patterns driven by human psychology and mathematical inevitability. Periods of easy money and speculation always end the same way. Debt levels that seem sustainable during good times become crushing when conditions change. Asset prices that appear justified by new paradigms eventually return to historical norms with devastating speed. And that's exactly what's building now. We're living through the greatest debt expansion in human history. Total debt in the United States, including government, corporate, and household borrowing, exceeds $90 trillion. More than 4 times the entire GDP of the country. It's a level of indebtedness that has never existed before without eventually triggering a crisis. Corporate debt has reached levels that make the 2008 crisis look conservative. Companies have binged on cheap borrowing for over a decade, using the money not for productive investment, but for financial engineering. They've bought back their own stock to inflate share prices. They've paid dividends they couldn't afford from operating cash flow. They've made acquisitions at inflated prices using borrowed money. This works wonderfully during good times when revenues are growing and refinancing is easy. But when the cycle turns, when sales decline and credit becomes expensive or unavailable, these heavily indebted companies face existential threats. Government deficits are spiraling toward a point where even the world's reserve currency may not be able to handle the load. The federal government is borrowing trillions of dollars each year to fund spending that far exceeds tax revenues. Interest payments on the national debt now exceed spending on defense, approaching $1 trillion annually. This creates a vicious cycle. Higher debt requires higher interest payments, which require more borrowing, which leads to even higher interest payments. Eventually, the mathematics become impossible. Either the government defaults on its obligations, or it prints money to pay debts with currency that's worth less each year. Both outcomes destroy wealth for those holding government bonds and currency. Consumer spending, which accounts for about 70% of economic activity, is being supported by credit cards and loans that assume tomorrow will always be better than today. Household savings rates have collapsed. Americans are spending more than they earn, making up the difference by borrowing. This works until credit limits are reached or income declines, and then it doesn't work at all. Meanwhile, asset prices have been inflated by over a decade of artificially low interest rates and money printing on a scale that would have been unthinkable to previous generations. The Federal Reserve expanded its balance sheet from less than $1 trillion before 2008 to over $8 trillion at its peak. That's $7 trillion of new money created and injected into the financial system. That money didn't go into the real economy. It went into financial assets, inflating stock prices, bond prices, and real estate values far beyond what underlying economic fundamentals could justify. Stock prices are divorced from underlying business fundamentals. Companies that lose money quarter after quarter trade at market capitalizations that exceed the GDP of entire nations, justified by stories about future potential rather than current reality. Real estate values in many markets have reached levels that make ownership impossible for entire generations. The median home price in major cities exceeds 7, 8, or even 10 times the median household income. Historically, that ratio has been around 3 to 4 times income. Current levels are mathematically unsustainable. But mathematics doesn't care about assumptions or wishes or government interventions. The laws of economics assert themselves eventually, regardless of how much effort goes into suppressing them. Interest rates are rising because inflation refuses to disappear. After years of ultra-low rates, Federal Reserve has been forced to raise borrowing costs to fight inflation that reached 40-year highs. Higher rates make existing debt more expensive to service. They also make new borrowing more difficult, which slows economic activity and exposes companies and individuals who are dependent on continued access to cheap credit. Debt service costs are consuming larger portions of government budgets, corporate earnings, and household income. Money that once went to productive investment or consumption now goes to interest payments. This creates a drag on economic growth that compounds over time. Corporate earnings are under pressure from higher labor costs and slowing demand. Workers are demanding wage increases to offset inflation. At the same time, consumers are pulling back on spending as their own finances become strained. Companies are caught in a squeeze where costs are rising and revenues are falling. The stage is set for a correction that will make 2008 look like a minor inconvenience. But here's the opportunity that most people will miss completely. When the crash comes, it won't destroy real value. It will simply reveal which assets were real and which were illusions. Quality companies will survive and eventually thrive. They'll use the downturn to acquire weaker competitors, gain market share, and strengthen their competitive positions. Prime real estate will retain its utility, even if prices fall. Land in desirable locations has intrinsic value based on scarcity and usefulness. Precious metals will maintain their role as stores of value when paper promises fail. The difference between those who profit and those who suffer won't be luck or timing. It will be preparation. Those who understand what's coming can position themselves to benefit from the chaos that destroys unprepared investors. The first step in positioning yourself for the crash is understanding that your current financial strategy is probably wrong. Most people are trained to think like consumers, not investors. They buy when prices are high, and everyone is optimistic. They sell when fear takes hold, and assets are cheap. This backward approach guarantees they'll be on the losing side of every major transfer of wealth. Successful crash investing requires a complete reversal of normal human instincts. When your neighbors are celebrating their portfolio gains and talking about early retirement, that's when you should be building cash reserves and preparing for the inevitable downturn. When panic grips the markets and financial media is predicting the end of capitalism, that's when generational fortunes are made. The wealthy understand this principle because they've seen it play out repeatedly. They know that fear creates the best buying opportunities in history. They know that when everyone else is desperate to sell, assets can be acquired at prices that seem impossible during normal times. They know that patience and preparation beat emotion and speculation every single time. Cash becomes king during financial crisis, but not for the reasons most people think. It's not about safety or preservation, it's about opportunity. Having liquidity when everyone else is forced to sell creates purchasing power that can generate returns for decades. The investors who accumulated cash during the euphoria of 2006 and 2007 were able to buy real estate stocks and businesses at prices that created multi-generational wealth. They weren't smarter than everyone else. They were more disciplined. They resisted the temptation to chase returns during the bubble, accepting lower returns in the short term to have ammunition for the crash. They knew it was coming. But cash alone isn't enough. You need to understand which assets will survive the storm and which will be revealed as worthless when the tide goes out. History shows that quality always wins in the end. Companies with strong balance sheets, consistent earnings, and essential products or services not only survive crashes, but often emerge stronger than before. They use the chaos to acquire competitors at fire sale prices, expand market share while weaker rivals fail, position themselves for the recovery that always follows. These are the businesses you want to buy when fear is at its peak and prices have collapsed. Real estate follows a similar pattern, but location and quality matter more than ever during downturns. Prime properties in desirable areas may lose value temporarily, but they retain their fundamental utility and scarcity. People still need places to live and work. Businesses still need locations with good access to customers and employees. Land in the path of long-term growth doesn't become worthless just because prices fall. Meanwhile, speculative developments in marginal locations often become completely worthless. Properties that were built on the assumption of perpetual growth and easy financing find no buyers at any price when conditions change. The key is identifying assets that will be valuable regardless of economic conditions. Precious metals have served as wealth preservation tools for thousands of years, but their role during crashes is often misunderstood. Gold and silver don't necessarily make you rich during economic turmoil. They preserve purchasing power when currencies lose credibility and financial systems break down. They're insurance policies against the complete collapse of paper-based wealth, not speculation vehicles for generating returns. When governments print money to pay debts, when central banks expand their balance sheets by trillions, when currency debasement accelerates, precious metals maintain their value because they can't be printed or created by decree. They're real assets in a world of paper promises. The timing of your moves matters more than most people realize. Starting to prepare after the crash begins is like buying fire insurance while your house is burning. The opportunities are created during the build-up phase, when debt levels are rising. Asset prices are inflated, and optimism is widespread. That's when you accumulate cash, research quality investments, and position yourself for the inevitable reset. Dollar cost averaging becomes a powerful weapon during market crashes, but only if you understand how to use it properly, instead of investing fixed amounts regardless of market conditions. You increase your purchases as prices fall and decrease them as prices rise. This approach allows you to accumulate more shares of quality assets when they re-cheap and fewer shares when they re-expensive. The psychological challenge is enormous because everything in your environment will be telling you to do the opposite. Financial media will be proclaiming new paradigms and permanent prosperity during the build-up phase. Your friends and colleagues will be making paper profits and questioning why you're being so conservative. Social pressure to participate in the speculation will be intense. Then, when the crash arrives, the same media will be predicting permanent depression and the end of capitalism. Your social circle will be panicking and telling you it's too dangerous to invest. Every instinct will be screaming at you to preserve whatever cash you have left and wait for certainty before making any moves. This is exactly when fortunes are made. When fear is at its peak and everyone else has given up hope, that's when quality assets are available at prices that seem impossible. The investors who bought during the depths of 2008 and 2009 weren't lucky or particularly smart. They were disciplined enough to act when action felt most dangerous. They bought Bank of America at $3 when everyone said the banks would never recover. They bought real estate when people were convinced prices would fall forever. They accumulated stocks when the financial media was questioning whether capitalism itself would survive. And they were rewarded with returns that changed their lives. Debt becomes your enemy during financial crisis because it forces you to sell assets at exactly the wrong time. Leveraged investors who seem brilliant during the boom become casualties during the bust. They're forced to liquidate positions to meet margin calls or service payments, often at the worst possible prices. Staying debt-free gives you the flexibility to buy when others are forced to sell. This is why the wealthy often use other people's money during booms, but maintain their own liquidity. They borrow to acquire assets when credit is cheap and abundant, but they don't over-leverage to the point where they're vulnerable to margin calls or forced liquidations. They always maintain enough cash and unencumbered assets to survive extended downturns. The businesses that thrive during economic chaos share certain characteristics that you can identify before the crisis begins. They have strong cash positions that allow them to survive revenue declines without cutting to the bone. They have low debt levels that won't crush them when refinancing becomes difficult or impossible. And they provide essential goods or services that maintain demand, regardless of economic conditions. People still need food, healthcare, utilities, and basic services during recessions. Companies providing these necessities are much safer investments than luxury goods or discretionary spending businesses that see demand evaporate when consumers tighten their belts. The geographic dimension of this crisis adds another layer of opportunity for those who understand it. Economic disasters rarely hit all countries simultaneously or with equal force. The Asian financial crisis of 1997 devastated Thailand, Indonesia, and South Korea, while creating opportunities in other markets. The European debt crisis that began in 2010 hammered Greece, Portugal, and Spain, while strengthening Germany and the Netherlands. The coming crisis will likely follow a similar pattern, with some regions suffering more than others. Currency relationships become crucial during these periods. Investors who hold assets in strong currencies while living in weak currency countries can maintain purchasing power even as local prices soar. Real estate purchased with dollars in countries where the local currency is collapsing can provide both shelter from inflation and massive returns when measured in the original currency. The key is identifying which currencies will strengthen and which will weaken before the crisis makes the relationships obvious. Reserve currencies backed by productive economies tend to strengthen during global turmoil as capital seeks safety. Currencies of highly indebted nations with weak economic fundamentals tend to collapse as investors flee to safer alternatives. Commodity cycles overlay the financial cycles in ways that create additional opportunities. Basic materials like energy, metals, and agricultural products tend to spike in price during the early stages of monetary crisis as investors flee paper assets. But they often crash during the deflationary phase, as economic activity slows and demand collapses. Understanding these patterns allows you to ride the waves in both directions. Buying commodities before monetary expansion drives prices higher, and selling before recession drives them lower. The compound effect of crash investing is what separates the wealthy from everyone else. Buying quality assets at depression prices doesn't just preserve capital, it creates the foundation for exponential growth during the recovery phase. Assets purchased at 20 or 30 cents on the dollar can generate returns that dwarf anything possible during normal market conditions. Assets purchased at 50% discounts that recovered to normal values provide 100% returns. Assets purchased at 70% discounts that recover provide over 300% returns. These aren't theoretical calculations, but historical realities that repeat during every major financial crisis. But the real wealth multiplication comes from reinvesting those crisis gains during the recovery phase. Investors who doubled their money buying assets during the 2008 to 2009 crash and then used those gains to buy more assets during the following bull market achieved returns that transformed their entire financial lives. The combination of crisis buying and recovery compounding creates generational wealth for those disciplined enough to execute the strategy. This is how the truly wealthy think about market cycles. They don't fear crashes. They anticipate them, prepare for them, and position themselves to profit from them. So they understand that the greatest opportunities come during periods of maximum fear, and they have the emotional discipline to act when everyone else is paralyzed. The infrastructure for the next great wealth transfer is already being built, but most people are looking in the wrong direction. While everyone debates whether artificial intelligence will replace human workers or if electric vehicles will dominate transportation, the real revolution is happening in the financial system itself. Central banks around the world are quietly preparing for a monetary reset. That will make the 2008 crisis look like a practice round. The Federal Reserve. Its balance sheet has expanded from less than $1 trillion before 2008 to over $8 trillion today. That represents $7 trillion of new money created and injected into the financial system. European central banks have pushed interest rates into negative territory, essentially paying borrowers to take money. Japanese monetary policy has become so aggressive that the central bank now owns more government bonds than the government itself issues each year. These aren't temporary emergency measures anymore. They become permanent features of a system that can no longer function without constant artificial support. But artificial support always has limits, and we're rapidly approaching them. The mathematics are simple and brutal. When debt grows faster than the economy's ability to service it, something has to give. Either the debt gets paid back with currency that's worth less each year through inflation, or the debt defaults and destroys the institutions that created it. Both outcomes transfer wealth, but in very different directions and through very different mechanisms. Currency debasement rewards those who own assets and punishes those who hold cash or fixed income investments. Real estate, stocks, commodities, and precious metals tend to maintain their value in inflation-adjusted terms, while bonds, savings accounts, and pensions lose purchasing power every day. This is the slow-motion wealth transfer that's been happening for decades, but it accelerates dramatically during crisis periods. Debt defaults work differently but achieve the same result. When borrowers can't pay, lenders lose money, and assets get liquidated at fire sale prices. The investors with cash can acquire these assets at fractions of their normal value, while the previous owners lose everything they thought they had built. This is the rapid wealth transfer that happens during acute crisis periods like 2008. History doesn't repeat, but the patterns are impossible to ignore. The 2026 crash isn't coming to destroy your future, it's coming to create it. The question isn't whether you'll survive what's ahead. The question is whether you'll be prepared to seize the greatest wealth transfer opportunity of your lifetime. Every 18 to 20 years, the system resets. Every time, wealth transfers from the unprepared to the prepared. Every time those who see it coming profit, while those who ignore the warnings suffer. The choice is yours. Will you be on the right side of history? Or will you join the millions who learn too late that ignoring mathematical reality doesn't make it disappear? If this opened your eyes to what's really happening, hit subscribe. We're going to track every warning sign, every positioning strategy, and every opportunity that emerges as we approach the greatest wealth transfer in modern history. Drop a comment and tell me, are you positioning for the crash, or are you hoping it won't happen? Do you see the pattern repeating, or do you think this time is different? And if you want to know exactly which assets to buy when the panic hits, check out the video on screen now about the specific sectors and companies that thrive during economic chaos. Because knowing a crash is coming isn't enough. You need to know exactly what to do when fear is at its peak and opportunity is screaming at you. The next crisis is coming whether you're ready or not. The only question is which side of the wealth transfer you'll be on.